A quiet cough today masked what's really happening beneath the surface. Spec capital is running hot on defensive rotation, while earnings season uncertainty keeps liquidity cautious. The Nasdaq pulled back 0.57%, but the S&P barely budged at 0.14%, creating a divergence that tells us exactly where smart money is positioned. The data is screaming about profit-taking, not panic. Indices shed fractionally while the VIX cooled 2.4 points to 16.64. This inverse relationship, prices down but fear down, signals calculated exits rather than flight. The Nasdaq 100 led losses at 0.57% because mega-cap tech is where quarterly estimates are tightest, and investors are trimming exposure before earnings reports hit. Credit markets are holding their breath. The 10Y Treasury jumped 63 basis points to 4.66%, which means institutional money is pulling back from equities into duration hedges. This isn't a yield chase. It's a positioning move as the Federal Reserve balances between rate cuts and inflation stability. Our metrics confirm capital rotation, high-yield bonds, HYGW flat, suggesting credit spreads aren't widening despite equity weakness. Fear is cooling off, not spiking. UVXY gained 0.34%, while VIXY added 0.24%. Yet the underlying index dropped, indicating traders are hedging selectively rather than buying fear wholesale. The Russell 2000 shed 0.92% versus 0.57% for Nasdaq, meaning small caps are overexposed to sector rotation. Our indicators show liquidity is concentrated in large cap defensives, while mid-caps struggle with earnings uncertainty. Earnings season is the silent driver here. 13 market headlines and 12 tech stories confirm what the numbers reveal. Semiconductor and software earnings are the pivot points for this week's direction. SMH actually gained 0.33% as chipmakers reported better than expected margins, but XLK lagged at 0.72%. Exposing a divergence between individual companies and sector performance. Safety is selective, not absolute. GLD surged 1.24% while TLT dragged on long-duration bonds, meaning investors are buying precious metals as insurance without committing to full bond portfolios. XLP food staples added 0.33%, confirming defensive rotation into consumables rather than utilities or healthcare. The portfolio's natural defense mechanism is activating, but the attack is still in early stages. The hero, your portfolio, faces a tactical threat, earnings uncertainty combined with speculative capital rotating out of growth names. Smart money isn't panicking, it's positioning. SMH proving positive while ARKK bleeds 2.46%, shows rotation is sector-specific, not market-wide. The VIX cooling 2.4%, confirms this is controlled profit-taking rather than a cardiac event. Protect your exposure to mega-cap tech until earnings clarity emerges. But don't mistake today's cough for the start of an infection. The Canary dashboard shows defensive positioning without panic. Exactly what you want before earnings volatility peaks. The next 48 hours will define whether this is profit-taking or the calm before a deeper move. Stay positioned in large-cap defensives while monitoring semiconductor earnings for directional clarity. This is how we keep your portfolio singing through earnings season.